What's good, everybody? Spektrades back here with another video. This right here is going to be a deep masterclass on fair value gaps and liquidity. We're going to pair liquidity and fair value gaps to make this powerful trading strategy. This is one of the best strategies and it works super consistent. So make sure you pay attention and take a lot of notes. Like and subscribe and comment down below where you're from. Without further ado, let's get straight into this video right here. First, let's go over the liquidity trap. Liquidity is the fuel smart money used to move price. Retail stop orders built up above equal highs and below equal lows. The liquidity sweep is the engineered move that triggers the stop, then providing the liquidity for smart money to enter in their opposite direction. The key is that after every liquidity sweep precedes a displacement move. As you can see right here, this is our liquidity sweep. A lot of traders might have taken this trade right here. Price went higher and respected this old high to then extend lower and give us a market structure shift. On the pullback, a lot of traders might have placed their trades right here. But this right here is a low resistance liquidity run. This is what we call a low resistance liquidity run. First, we see that price extends higher and clear that low resistance liquidity to then extend lower and give us a market structure shift. Now on that pullback, this is our displacement move, because on that pullback, all we're looking for is a fair value gap. The recent fair value gap, price used that to then extend lower to clear these sell side liquidity lows. But before we got this clean extension move, what did price do first, right? Always pay attention. Before price gave us this strong displacement move, right? Liquidity happened first. Liquidity sweep often precedes a displacement move. Always remember that before the real move happens, price has to give us a manipulation. It has to trick out a lot of traders. It has to. Without that, price won't deliver how we want it to. Next, you have your fair value gaps as your entry engines. The FVG is the inefficiency where price didn't take trades on both sides. It acts as a magnet. Whenever you may hear that the fair value gaps are like a magnet, that's what we talk about, because price always pulls back and fill a fair value gap before extending higher. For a confluence boost, a fair value gap right after liquidity sweep or a high probable entry zone. Whenever you can stack confluences together, that makes that entry. So if you have a liquidity sweep, a fair value gap, or a order block, all of them align all together, that's right there is a plus type of setup. We use the 1 hour and the 4 hour directional bias. Then we scale down on the 5 minutes to the 15 minutes time frames to execute. We do this every single day on a daily basis. We use the 1 hour to 4 hour zones, the 4 hour fair value gaps, 4 hour directional bias. So if we see a 4 hour fair value gap, as you can see right here, I'm not gonna take a trade inside of this, but if I'm down here, I'm gonna look for price to pull back inside of here. So this is gonna be, so this right here, this 4 hour fair value gap gonna tell me where price is more likely to pull to, while I take this reversal higher. All right, that's why we use the higher time frame zone. But we scale down on the 5 minutes and the 15 minutes to minimize our risk to catch the sniper entries. Now let's get into the blueprint combo. First, we need a liquidity sweep, a displacement, and our fair value gap entry. All right, it's only 3 things: a liquidity sweep, a displacement, and the fair value gap entry. First, we need a recent liquidity pool taken, right? Make sure you watch my previous videos on liquidity where I show all the types of liquidity. We have equal lows, equal highs, consolidation zones, sideways pattern liquidity. It's a lot of different types of liquidity, right? So a liquidity pool has to taken out first. Second is a strong displacement candle confirms the intent. Basically, as you can see right here, price first pushed down lower to clear these equal lows. So we have this strong liquidity sweep, clear these equal lows. Next, we have a strong displacement candle. This right here breaks through this prior candlestick high. This is a market structure shift. Price was going down, right? Look at this. But once we broke through up here, the trend changes, right? Price is now in a uptrend. So on the pullbacks, it's just looking to retest a recent zone to then continuing price. Next is that we look for a fair value gap form. That's our entry trigger, right? It's multiple ways you can take your trade inside the fair value gap. Always wait for displacement after the sweep. Never fade the first move. Like I stated, we wait for the liquidity sweep, right? Wait for that manipulation to happen, and then let that displacement happen, and let price come back to you. Because the fair value gaps, they're a magnet. It will pull back. Don't doubt it. It will come back and fill that fair value gap. It may not be during your session, right? Sometimes it doesn't happen during the session, but later in time, it always pulls back and fill those fair value gaps. Your entry at the fair value gap retrace in the direction of the displacement, and your stop loss is beyond the sweep highs or the sweep lows, and target the opposite liquidity pool or imbalance zones. The risk to reward for this model is usually a 1-2-3R or a 1-2-2, right? But me personally, I always target the recent highs. Let's look at this example right here. This was a beautiful trade right here, right? This is the strategy in action. Let's go right here. First, we see that price push down lower and give us a liquidity sweep of these equal lows. Then price extend higher, this market structure shift. On the extension higher, we have a full body breakup structure of this prior candlestick high. This was the last bullish candlestick before we started fully extending, right? So once price breaks through this, we have a new dealing range from this old low to this prior high right here, right? So everything down in this zone right here is our discount zone. Like the first rules of trading is buy low, right? Buy low and sell high, right? That's like a quick rule in trading. You buy low and you sell high. So as you can see right here, like we stated, the fair value gaps is the magnet of the market. As you can see, price left this fair value gap from this open to this close right here. Perfect. We usually use our quadrants, right? Your quadrants is the open, the 25%, the 50%, the 75%, and the close, right? So these right here, the three middle ones are the most important quadrants, right? Me personally, I always like to place my trade in the 50% of the fair value gap, right? The 50% is like one of the most powerful, but sometimes, right, a quick key I gotta tell y'all, right, is that the 25%, a lot of the times I miss some trades because price only use the 25%. So I would recommend, right, if you are a trader, to use the 25%, right? If you're like on the higher time frames, possibly on the 4 hour, and you're using like a higher time frame fair value gap, then I would say the 50%, or even on the 15 minutes, 30 minutes, right, the 50%. But on the lower time frames, if you're scalping, right, the 25% is usually perfect, just because like during the lower time frame scalps, price is not really trying to go too deep inside of the fair value gaps. More like this is like a day trade right here, like a 15-minute day trade. But on the lower time frames, price is more likely to just wick inside of the fair value gap, use the 25%, and then extend higher. And all we're looking for is for price to just mitigate that zone to then continue price. So price pull back. This is our magnet, the fair value gap, and we have more confluences, right? Like I stated, if you have a fair value gap in a order block, that adds on even more. So we have this old broken order block right here, right? This bearish engulfing order block, price was supposed to come into it, use it to then push down lower, right? Price purge right through it. So now this has become a support level also. And aligned with this fair value gap, this right here is a A+ setup. If you ever see something builds like this, I love ranges like this. Whenever I see trades like this, I just know I'm gonna make some money, right? If you miss this trade too, on the rally higher, once you get a firm body candlestick break, look at this right here. Price just pulled back, retest that open, boom, right, and clear this old highs right here. But this was just a beautiful trade right here. But now let's hop on the charts and go over multiple examples of how we execute this liquidity sweep and this fair value gap model. So make sure you stay tuned and take notes. Now we're back on the charts. We're gonna look at the London session model first. As you can see right here, this is our trusty Asian range indicator, right? I love using this indicator right here, right? This is gonna be the settings. So make sure you just pause the video and just grab it right here. It's super simple, right? These are just the times. It's just nothing really crazy about it. The main reason I like it is just it shows me the Asian session, because the Asian session harbors a lot of liquidity above and below the Asian session, right? So you can see right here, right after the Asian session ended, price left this equal highs. Always ask yourself this, like, why do price leave these relative equal highs, right? because like before we have our reversal, price has to give us a manipulation or a trap. Imagine how much traders want to take a short just in here, right? Just in this zone right here, especially in this order block, right? You kind of see that price started already going lower, but price already went higher again to clear it. All of this right here was just liquidity, right? That's number one, like we stated, is that we have to find our liquidity sweeps. So as you can see right here on the 15-minute time frames is what I'm looking at right here on the 15-minute time frame. So the London session kill zone is from 1 a.m. to around, I would say 5 a.m. right? 5 a.m. EST or around like 7, right? 7 is like London close. We call it the London close, right? So from 1 a.m. to 7 a.m. you have the London session kill zone. This is where you usually have your reversals and your manipulation, just like you see here. Price already rallied higher to clear this Asian session high, and now we're getting our displacement move. That's the second thing we're looking for, is the displacement. So you have your liquidity sweep, then your displacement move. Now we're looking for the entry point, right? This is just the fair value gap. This right here is our fair value gap. This is where we want to see price pull back, mitigate our zone to then extend lower. And it's always two ways you can take your entry. For the risk entry, all you have to do is just place your trade right here, your stop loss at the prior candlestick highs, and you're going to target this prior old low down here, right? But this is our day trade right here. This is your set and forget. If you come in the market and you see this pattern happen and you already position yourself, you could just place this in and set it and watch it and forget it. The only difference with this is this, I would say, is that your stop loss may be a little bit bigger. That's the main reason. The risk entry is maybe a little bit better for some people that can't be on the charts a lot. You are like an active day trader waiting for price to come in inside of your zone and give you a lower time frame shift. Then you get that confirmation entry where you can scale in. That right there may be that correct entry for you to just load up even more, right? For you to scale down lower, right? But first, we're gonna see price pull back inside of this zone right here. Just like I stated, it's always two things you can do. You can see price pull back and mitigate the 50%. So this could be like a set and forget type of trade. Or if you go down on the 1 minute, now on the 1 minute, this is the 15-minute fair value gap that price pulled back into, right? We see that on the 1 minute, we got a liquidity sweep and a market structure shift. And this right here is a lower time frame displacement move. It left this order block that's aligned with this fair value gap, right? This is extremely powerful, right? Because if you miss this risk entry and you didn't want to have like a bigger stop loss, you can scale down on the lower time frame and catch that confirmation entry, right? This is your confirmation entry. Your entry at the open of the fair value gap and your stop loss always at the candlestick highs. And for your targets, always target this recent liquidity pool right here for a 1-2-3R, right? Just like I stated, me personally, a 1-2-3R is better than like most, I would say, right? If you can scale in and use a correct contract or lot size right here, this is more than enough, right? Or you can just hold your trade all the way down here, but don't get greedy, right? Just like I always say to my students, to not get greedy, because you don't know what price may do right here, right? Because this is a old point of liquidity low. Price may use this to then reverse. So after you place your entry and your stop loss at the high, your take profit is the recent pool of liquidity, like I stated, right? We're just looking for a pullback to then continue to the recent next pool of liquidity. Boom. Nice and simple. As you can see, price pull back and drop lower and give us our take profit. It even dropped even lower, right? But like I stated, don't get greedy. Train yourself to always take your profits at a recent pool of liquidity, because you never know what, right? You never know when price may reverse or like the correct move. Now let's get into our next example. This is a buy model reversal. I always use my Asian session. We can see that price was giving us this lower time frame movement where we're pushing down lower, pull back, respect, push down lower, right? It's just consistent pullbacks, right? Consistent pullbacks. Then we see that price was just giving us breaks, right? Price was just clearing all these lows. So we see that price extend lower, cleared this old low, and then started giving us this strong displacement move. Just like I stated, once we see that price breaks through these internal range highs, we have a new dealing range from the prior low to this prior high right here, right? So even though we were once in this downtrend, the trend changes now, right? We want to be in this uptrend state now. So this is a New York session type of trade. I'm on the 15-minute time frames, right? The New York session starts from 8 a.m. to around 12 or 1 p.m. I just put 12 right here. This is the noon from 1. This is where price slows down completely. So the volatility is dead. But as you can see right here, right between this displacement, right? Price left this fair value gap. Just like I stated, right? Our quadrants is super important. For this right here is more of a liquidity void type of fair value gap. If you have a fair value gap like this, a liquidity like a big gap like this, I would truly recommend you put your entry at the 50% and your stop loss at the candlestick lows, right? Or, right, even the 75% may be even good too, because this is a bigger fair value gap. With the bigger fair value gaps, price want to like dig deep into them, right? Make sure it grabs everything first before extending higher. It may not close it. Sometimes I even see fair value gaps close completely, right? And use this right here, right? This as a entry zone. So that's why our stop loss is always at the candlestick low, right? Just in case. All of it is just in case price pulls back a little bit deeper, right? You're not afraid when you're in the trade. You're just letting it run. That's why we manage our risk properly. I may only have one micro. So if I'm in a drawdown state, I'm probably down like $50. But once price breaks through that entry range high, right, and comes back to my entry, that's when I scale in. All my students know this. That's when we scale in to then attack these prior highs right here. But come in your side of your trades slowly, right? Come inside of your trades slowly, manage your trades properly. And once you get that confirmation entry, right, that's when you scale in heavily. So we see that price push down lower. For this one right here, price actually mitigate the 75%, like I stated, right? But the 50% is also perfect, right? This just have a good size stop loss. But this is just mainly a day trade, right? It's a day trade type of model right here. Perfect. To then extend higher. Perfect, right? But just like it's a day trade model, if you were like, if you have good eyes, you can kind of see the lower time frame scalp. I'm gonna show y'all this right here. If you have good eyes, any students that's been studying for real, it's right in front of you every time, right? So after price mitigates this right here, we got this liquidity sweep. Perfect. Then we get this internal range break. This right here is your confirmation entry, right? On that pullback, we just want to see price pull back, mitigate, boom. Nice and simple, right? We just use the fair value gaps to catch two beautiful entries. And this is just like, this model right here is probably one of the most simplest ones. This is because like you can anticipate the whole reversal really. This is because you know your draw on liquidity points, this prior Asian high. We're trading during the kill zone times. We waited for the first liquidity sweep. Price was giving us consistent liquidity sweeps. Then we wait for price to give us that displacement move to break through this internal range high right here, right? This is super mechanical. That's why it looks so clean and it works, because it's mechanical. You have to wait for this to happen, wait for this to happen. And if this happens, then you do that, right? You're like a robot, because the algorithm is a code. It's a robot. So you have to think like the algo. You have to become the algo, and then you will be the algo. I hope you guys learned a lot of this video right here. Make sure you watch my previous videos where I break down a lot of other concepts, and go through the playlist also. If you are new here, where I have a full hour trading course, so you can just go through it and master all the concepts. But welcome to the Spark family. This is it. Spektrades out.